China's economy is starting to slow down. The sharp rise that was caused by the opening up of the economy after the COVID blockade is now coming to a halt. Consumer prices are falling, the property crisis is deepening, and exports are declining. Youth unemployment has worsened so much that the Chinese government has stopped publishing real data. Where does the Chinese economy really stand, and does it have the opportunity to catch up with the American express train? How will the slowdown in the second largest economy affect America and the whole world? The answers to these questions can also be found in this video. Before we go any further, if you are interested in investing in economics, support me by following me and turn on your bell so you can always be informed about new videos. The Chinese economy has changed incredibly over the last couple of decades. The extreme poverty rate in China 1981 was at 88%. Today we are at somewhere around 0. To fall into the definition of extreme poverty, you would have to earn less than 1.9 American dollar per day. What happened to turn a country that had huge poverty a couple of decades ago into one of the largest economies? The turning point came when Chinese government officials realized that the main advantage China had was the number of people, i.e., cheap labor. This cheap labor means that companies can employ more people for less than competitors from other countries. This has also meant that products have been significantly cheaper than anywhere else in the world. Of course, other countries immediately liked this. In 2009, China became the export leader. Last year, China's exports were worth 3.7 trillion American dollars. Since the mortgage crisis, the Chinese economy has grown by 4 trillion American dollars every 4 years. For simplicity's sake, that's an increase in China's economy every 4 years by the size of India. According to Goldman Sachs Bank, China is expected to overtake the US in 2041. Is this growth realistic and sustainable? Because we can already see China running out of breath. Various financial institutions, such as UBS, Nomura, Morgan Stanley, and Barclays have lowered their forecasts for China's real GDP growth. As the downturn in real estate has deepened, external demand has weakened, and political support has also been less than expected. Another reason that is weakening China's economic situation is the labor market. We can see how unemployment among young people has increased in recent years. These are the people who, in time, should be able to pull the whole economy together, but they cannot find a job today. From 2021, unemployment among 16 to 24-year-olds has risen from 15.4% to 21.3% this year. This is data that has been approved by the Chinese government. According to various experts, the real data is significantly higher. One respected Chinese professor claims that unemployment among young people could have reached as high as 46.5%. To give you an example, the G7 countries average only 7.8% unemployment for young people. But what is the reason that companies are employing fewer young people? The answer is that the Chinese government is not exactly a big supporter of wealth creation for individuals. By individuals, of course, I mean large companies that employ thousands of employees. Something similar has happened in the case of Alibaba. Its founder, Jack Ma, has criticized the Chinese government and as a result has lost over 30 billion American dollars of his fortune, and his position in China has been greatly diminished. In addition, government institutions have also rejected the IPO of another of his companies and fined his companies for various offenses. This is just an example of how not to mess with the Chinese government, because the Chinese Communist government is at the very top, and if you want to do business in the country, you have to be on good terms with it. That is why companies are rethinking whether they want to expand in the country or move to another market. It is for this reason that the supply of young people has been reduced, and even large technology companies have started to lay off. For example, Alibaba laid off 7% of its workforce, Tencent laid off 5,500 in Q2 and 1,900 in Q3, or Xiaomi laid off 35,000 workers. And there are many more such reports. This is not the only reason that prevents young people from getting a job. The number of Chinese students has increased significantly compared to the past. It's just that the jobs that are available are mostly focused on manufacturing and assembly. That is to say, these jobs are different from the kind of education they have received, and the financial valuation is significantly lower. In addition, the flow of investment into the country has also stopped. The indicator of foreign direct investment FDI into China has fallen into the red for the first time since 1998, underscoring the country's inability to stem capital outflows. Speaking of investment, China's main stock index, the Hang Seng, is also underperforming this year. It is down 12% since the beginning of the year and is down 46% from its overall peak. As I mentioned a moment ago, some of these companies have been unable to align their interests with the communist government and have therefore decided to relocate their factories to other countries. For example, Apple is moving its factories to India, or companies such as Intel, Microsoft, Nike, or Dell have moved part of their production. Personally, I think that the number of companies that do not agree with the Chinese government will increase, and so the outflow of capital from China will increase. Another reason why the Chinese economy is slowing down is the real estate market, which is slowly but surely freezing up. Concerns were compounded after one of China's largest developers, Country Garden, declared that it was unable to pay its debts in American dollars. The news revived memories of Evergrande, whose default on its debts in 2021 signaled the beginning of a real estate crisis. As we may recall, the developers at Evergrande lied to their customers as mortgage repayments were used to build new residential properties. When the flow of this money stopped, neither the original nor the new properties under construction could be completed, and so most of them had to be demolished. Beijing has put in place support measures for the property market, but it seems that they are not as supportive as the Chinese government thought, as even the 2.9 trillion American dollars investment trusts have announced that they will not be able to repay their debts in American dollars. That is to say, the investors who bought the bonds of these companies will get nothing. Of course, the investors did not just leave it at that and started protesting outside the offices of the management companies and demanding the redemption of the high-yield bonds. The next problem that has arisen in China is deflation, which means a drop in the prices of goods and services. It may not sound bad at first sight. After all, the prices of goods and services are falling. That's a good sign, isn't it? But deflation also carries risks, because lower prices will induce lower output, employers will cut wages, and thus the demand for products will be reduced, a vicious circle that will slow the economy. And this is exactly what may have a big impact on other economies than the US. Because we know that China is the largest exporter in the world, the amount of goods and services that China could provide will be reduced. Thus, exports will fall. And since we know that a large number of American firms have a significant share of their sales from China, American companies will also feel this decline. Just to give you an example, 19% of Apple sales are from China. When China banned the use of iPhones in government agencies, the stock shares immediately fell. Everyone knows that you can only do business in China if you have the government on your side. Because of that, I have not bought any financial instruments from China or companies with a lot of exposure to China in the last 3 years. Personally, the current situation is too risky for me and I can't read all the potential threats that may come from the Chinese government. I would even say that China is a non-investable environment for me. If you enjoyed this information, please support me by liking and following me so more people can see this content.